Welcome back. Let's talk markets now with Michael Zinn. He's Managing Director and Financial Advisor at UBS, and he joins us right now. Michael, thanks a lot for joining us. I'd love to get your take on these markets after a significant easing of tensions between China and the U.S. and the near completion now of S&P 500 earnings season, in which many companies have dialed back or suspended their forward-looking guidance. How do these markets look to you?
Yeah, well, good morning, Paul. I think the S&P 500 definitively punching above the 200-day moving average is a very supportive case for the bulls. And the trick now is whether we can kind of hang around here and endure, potentially negative earnings prints or macro data prints coming up. But, so far, so good. For example, we had CPI come in this morning, and as we woke up this morning, we saw the futures markets, the overnight markets, slightly negative, and they rebounded positively when the CPI data came in, and that seems to be following through this morning. So I think there's always going to be, a test, when the market, sees a negative data print, either on an earnings report or inflation or PCE or whatever it might be. How is it going to react to that, kind of absorb it? My sense is we are going to see more of a buy the dip mentality than a sell the rally mentality. And one of the reasons why I say that is because I think institutions generally did a fairly good job of avoiding the big decline in the broad markets, but they haven't really re-engaged for the rally. This rally has kind of been characterized as a hated rally. And as we have walked back this more oppressive tariff regime, I think what they call the left tail risks, the risks of inflation, the risks of recession, those have abated. The VIX is now below 18. So I think it's more of a green light for institutions to re-engage. And so I would expect more of a buy the dip mentality. And, I would characterize earnings season as actually pretty solid. It beat expectations. Yes, we had some areas like airlines and some areas of healthcare and autos, of course, say, look, we are having a lot of trouble forecasting it. But by and large, particularly when you look at tech earnings, I would say they were encouraging. They stuck by their CapEx numbers. Earnings came in pretty well. Guidance was solid. So we think the overall backdrop is relatively good here.
Before tariffs grabbed the spotlight as the dominant market story, there was concern about multiples in the U.S. Stock market. What's your take on where the S&P 500 is trading right now? My Bloomberg screen is telling me that the S&P 500 is now trading at 22 times expected 2025 earnings and 19, let's call it 20 times expected 2026 earnings. Right.
Yeah, I think that you're right that the market isn't cheap. I would say that coming into 2025, before the tariff decline happened, we had a little bit of a valuation problem, particularly as far as tech goes. You just had some super high valuation on particularly the AI names. That has deflated a bit. It is better than it has been, and earnings have come in better than expected. So valuation, I think, funny enough, tends to be an issue that can exacerbate things if there's a concern on the downside. But if the narrative shifts to being more positive, that we're going to transition now, I think, away from tariffs, more to the tax cut and jobs restitution from the 2017, more emphasis on that, on all these kind of deregulatory issues and tax cut issues. I don't see valuation being a big problem for the market as long as the news continues to be relatively favorable. So we're cheaper than we were. Not saying we're super cheap, but I think when you look at the alternatives and you look at, from our standpoint, the real yields on treasuries and cash, even an S&P multiple of 20-21 times implies a real rate of return of around 5%, and real yields on bonds are more like 2+%. So we still think that comparison is pretty favorable for stocks.
Okay, lots of insight into the state of the markets. With that in the background, how are you positioned now in client or model portfolios?
So we're about equal weight equities. Areas of focus for us continues to be tech in the US. We think that's going to continue to be a positive driver. We do think one consequence of the administration's policy is greater emphasis on manufacturing here in the US. So what we call reshoring, doing more things here, building more stuff here, we think is positive. So a lot of that grid infrastructure kind of play we're involved in. We do think financial deregulation is going to have some teeth in terms of the capital ratios of banks, ability to trade in crypto, lots of different areas, potential M&A activities. So regional banks, financials, that all looks pretty positive to us too. And the derivatives of AI, we think, are also still interesting. Some of the power plays related to supporting data center construction. So those are areas for us that I think will be good here in the US. We still like the overseas markets. I think that initial kind of surge we got during the tariff tantrum has abated, but I still see good values overseas as well. So we're putting some dollars over there too.
Michael, thanks a lot for this. Michael Zinn is Managing Director and Financial Advisor at UBS.